money. You can't afford to miss it. As Magnum Hunter, the highly speculative unconventional oil and gas producer that is down 39% since I recommended it in February of last year, always got to disclose your losses, finally found its way out of the house of pain. Magnum Hunter has some terrific assets, including acreage in the Bakken, in the Utica, Marcellus shales, and it's been growing production like crazy, up 137% in the latest quarter. But the stock has been held back by a host of problems. First, Magnum Hunter shut in a bunch of its natural gas wells last year, curtailed production because there wasn't enough processing capacity nearby. Then they had an accounting error, replaced their chief accounting officer. Last May, they did a big secondary. Oh, man, that got crushed. If you were in on that one, you just got annihilated. And then Magnum Hunter missed the numbers when it reported in November. Most recently, 2 weeks ago, we learned that the company's latest 10K filing would be delayed beyond the SEC's extended due date. Okay, you got the negatives. Today, we got some good news. Magnum Hunter has found a buyer for their Eagle Ford shale properties, which they've been trying to sell for a while. The company's selling its acreage to Penn, Virginia for $401 million. And they can use the proceeds to start cleaning up their balance sheet. Initially, the stock shot up 12% this morning in response to the news. But hey, come on, end of the lousy day, it was only up 11 cents or 2.9%. So maybe that's the beginning of a turn. Maybe that's the opportunity. Let's talk to Gary Evans, the chairman and CEO of Magnum Hunter, to learn more about the deal and what comes next for his company. Mr. Evans, welcome back to Mad Money.
Thanks, Jim. Good to hear you again.
Okay, you've got the money. You got the $401 million. Is this when you clean up the balance sheet and remove what a lot of people feel is just a speculative feel about Magnum Hunter? Or do you just put it all back in immediately and keep drilling?
No, it's definitely designed to pay down debt. We're going to, to build the positions we built in the Bakken, in the Marcellus, in the Utica, and the Eagle Ford, we had to take on debt. We took on senior bank debt, we took on senior notes, we took on perpetual preferred. Now we've got those positions built. We've taken our very first asset, which was the Eagle Ford. We've only owned it 3 years. We've generated over an 80% internal rate of return in 3 years, and we've sold it. Why? It's the smallest of the 3 plays that we're involved in. We only own 19,000 acres that we've sold. So we sold it to a company that adjacent to us that can, build mass and build scale. With that $401 million, we're paying off our senior bank debt. We'll redeem some of our perpetual preferred, and the liquidity question will be off the table.
All right, when will it be off the table until? Because I know that you've got some expirations, but you've got a lot of other debt outstanding. I don't want to minimize your full balance sheet issues.
Obviously, we have other debt. We also have close to 15,000 barrels a day of current production from those other plays. And we expect to still exit the year north of 20,000 barrels a day, even after the sale of the Eagle Ford. So we're still on a very fast growth path. And those dollars that were being expended in the Eagle Ford for drilling will now go into the Bakken, into the Utica, and the Marcellus. And remember, this was a January 1 effective date, so all the money we've spent since January 1 in the Eagle Ford comes back to us once we close.
Okay, would you tell me that's about 17% of your reserves, you were going toward more oil, less gas. Does this put it so you're a little more gassy after this sale?
Well, obviously the Bakken is all oil, and the Utica is 50% oil liquids, 50% gas. And so, yes, we'll be a little more gassy, but gas has gone from $2 to $4, so that's not a bad thing. We can make an unbelievable rate of return in the Marcellus and the Utica today with $4 gas, where returns are in the 60 to 70% range. So we're very bullish on where we think natural gas will go in the long term. We're very happy with $4 price. As you mentioned at the beginning of the show, we were delayed with a processing plant, came live December 17th. So now we can process all those wet liquids that come out of that gas stream in the Marcellus and Utica that we couldn't do in 2012.
Okay, now I know that you're bullish on it, but at the same time in your March 18th conference call, you said in 2013 you have 8,000 barrels of oil hedged at NYMEX 92.50, and you've sold 35 million cubic feet nat gas at $4.02. How much are you hedged? Is there still upside, or is the hedging so good we don't even need more upside?
Well, we're pretty well hedged for 2013. We haven't hedged much in 14 or 15. I think all of us have been a bit surprised at how well oil is held up in the mid to upper 90s. So we hedged almost everything we could on the oil front. Now today, just up in the Bakken, we're already running 5,500 to 6,000 barrels a day of production just on new wells we drilled. So we're really excited about 2013 homing in on these areas. And I can't emphasize enough how excited we are in the Utica. We think the Utica play will prove to be one of the best and the highest economic plays in the United States. And it's simple math. In the Eagle Ford, we would spend $8.5 million to find a 500,000 barrel EUR well. In the Utica, we'll spend $8.5 million finding a 1.5 to 2 million barrel well. So that's almost 3 to 4 times the economics of the Eagle Ford. That's why we want to be drilling in the Utica. Our first well actually spuds next Wednesday.
All right, next Wednesday.
Next Wednesday. We have a 16-well pad. It's taken us 2 months to build because of the terrible weather up there, but we are spudding our first well, and so this year will be the year of the Utica for us in our acreage position in eastern Ohio.
Okay, one last question. You know, we've been to Utica. We did our show there, but you are further west where there's a lot more oil, right? You are not in the gassy part.
No, we're all the way to the Ohio River, which is West Virginia. So that's about as far east as you can go in the state of Ohio. And then we go a little bit west. So we would be in both the dry gas window and the wet condensate window. We are not in the oil window. That's further west.
All right, fair enough, because I know that people want oil more than they want nat gas, but nat gas has gone up, and that does matter. Gary Evans, Chairman and CEO of Magnum Hunter, thank you so much for coming on the show.
Thanks, Jim. Appreciate it.
All right, guys, look, I was wrong when I first said I thought this was good spec at the 6 level. I think what they just did was conservative, get that $400 million in. I thought that was very important. It was a bad day for oil and gas, but at $4, okay. I say average down. Stay with Creighton.